The Asset Allocation Loss Ratio, AALR. What is it and how does it help you? So, now, when you go to any investment firm in Canada, they require you to fill out and sign a risk tolerance questionnaire of some kind. The purpose is to prevent you from investing too aggressively. So this can be important because you might sell a more aggressive investment and when it's down and lose money. However, there's two important questions. What prevents you from investing too conservatively? And can you achieve your life goals with the more conservative investments? So now these are critical questions since almost nobody can retire comfortably with a typical balanced portfolio with 40 to 50% in bonds. So investing too conservatively can kill your retirement. For example, a couple earning 100,000 a year together, saving to retire on 80,000 a year in 30 years with a balanced portfolio earning 5% a year would need to invest 34,000 per year. That's impossible. So that's the risk of investing too conservatively. So now this is where the AALR comes in. With any financial decision, it's important to understand how it affects your life, both the risk and the return. So the Asset Allocation Loss Ratio, AALR, estimates the effect of a more conservative portfolio or a suboptimal asset allocation on your long-term investment returns. So to see the effect, we need a comparison with a core investment that is not conservative. The best measure is a broad stock market index such as MSCI World Index or something like that. Stocks are the most reliable long-term investment for retirement planning, and the world is the broadest index. Now, the formula for the AALR equals the expected return of a core non-conservative portfolio minus the expected return of your portfolio. So for example, if equities conservatively long-term make 8% per year and bonds 4% a year, then having 25% in bonds reduces your expected return from 8% a year with 100% equities to 7% a year with 25% bonds. So this is an AALR of 1%. So similarly, a balanced portfolio with 50% stocks and 50% bonds is an AALR of 2% a year. Now, an AALR can result from adding bonds or fixed income to your portfolio, or it can be from suboptimal investments, such as having too much in, little old Canada, or focusing on low volatility or income stocks or something. So many investors, especially index investors, try to avoid paying for advice with an MER, but lose their savings with their AALR. A low-cost index investment might save 1% a year with a lower management fee, MER, but if they invest 25% bonds, they lose 1% return with their AALR. So, now, this low return is, of course, an estimate. However, it helps you understand the trade-off. So you fill in a risk tolerance questionnaire. It says you are moderate or you are conservative. So you end up with 25 or 50% in bonds or some other fixed income. What do you gain? You gain a feeling of security. So you have less volatile investments that should decline less in down markets. So what do you lose? You lose some freedom. So you have lower return investments and less freedom in your future. So it's critical for you to understand both sides of your decision to invest more conservatively. The next step is to see how the low return affects your retirement plan. How much less is the retirement income expected to be? Can you still live the future you want? So now only a financial plan will tell you for sure. So however, you can estimate it with a return comparison, until you retire and for the rest of your expected life. For example, if you're 30, plan to retire at 60 and expect to live to 90, then an 8% rate of return, if you have 100% today, in 30 years, it's $1 million, and in 60 years, it's 10.1 million. If you have 7% instead of 8, that 100,000 is 760,000 in 30 years and 5.8 million in 60 years. So in short, you get 25% less when you retire and 40% less over your life with a 1% per year lower return, the AALR of 1%. So now what's the alternative to living with this lower return? Because you do have to be invested within your risk tolerance. So the alternative is learn to have a higher risk tolerance. So risk tolerance is a learned skill. You can learn it. So now my definition of risk tolerance, it's the ability to do nothing when your investments are down. Really, that's all it is. Do nothing. How can you learn to have a high risk tolerance? So what you do is study it. So you study the stock market's long-term return and how often and how far it falls, how long it takes to recover, learn to what extent you can be confident with it, and then get professional advice and work with a financial planner that can help you stay invested if that is helpful for you. Now, if you panic and sell your investments after major market decline just once in your life, and a financial planner helps you stay invested, that alone could pay for the financial planner 30 years. So it's really that important to stay invested. So let's take a quick look at risk of the stock market. So this is just kind of an overview to give you a sense. We have the best records for the US market, the S&P 500. So it has historically fallen 20% every few years, 30% about once a decade, 40% once every 3 or 4 decades, and then 88% of declines are fully recovered in 1 or 2 years. The worst 25-year calendar return of the S&P 500 in the modern stock market, that's like since 1930, is 8% a year. So that's the worst return. So the point is, it is reliable long-term. It goes up and down a lot, but it's reliable long-term. So now many people don't think much about their money and tend to get labeled as conservative investors because they think the stock market is riskier than it actually is. So for example, let's give you a story here. So John and Jen earn $100,000 a year. That's $200,000 total. They want to retire in 30 years on $150,000 a year. We'll use 3% inflation and maximum government pensions. So now with a 100% equity portfolio earning 8% a year, they can achieve their goal by investing $2,700 a month. This is essentially maxing their RSP rooms. So now they go to a financial planner or a bank or a robo-advisor or a discount brokerage firm or somewhere. They fill out a risk tolerance questionnaire. It says they are moderate. So they are recommended 25% bonds, 75% equities. So this gives them an AALR of 1%, since their expected return is 7% a year instead of 8% a year. Now, they gain lower volatility. So the worst 1-year decline of their portfolio is 20% instead of 40% with a 100% equity portfolio. Now they lose growth because they invest the same $2,700 per month. When they retire, they can afford $125,000 a year, not $150,000 a year. So the trade-off question is, do they need the lower volatility to stay invested? Or can they learn to tolerate the higher volatility and get $25,000 per year more for their entire retirement? That's the question. Now, when you see both sides of this trade-off accurately and how it affects your life, only then can you make a smart decision about what is best for you. So to invest wisely, it's not enough to just fill out a risk tolerance questionnaire. That helps you avoid investing too aggressively, but might make you invest too conservatively. So know your AALR, be in control of your life, understand how the lower return of more conservative investments will affect your life.